Hello, everyone. Welcome to today's RetFed presentation on mastering your federal benefits. Um, Looking forward to talking for the next hour. Well, we have a couple housekeeping items. One, we always get asked about the recording of this presentation. Yes, it will be recorded. Yes, it will be sent to you via link. We always get asked additionally about the slide deck that will also be sent out to you. There is a function that also allows you to turn on closed captioning. Feel free to do that if you need that service. Additionally, there's a Q&A section. We'll be answering questions mostly at the end here just for everyone's time. There's about 200 plus individuals joining in. So we just want to make sure we get everyone out in a proper time. So most likely we'll have to switch these questions to the end for that. Additionally, guys, we will be offering a one-on-one consultation. If you have personal questions that you want to ask us that are not really the best for a group setting, that is going to be a option for you guys at the end of the presentation. We'll share with you that QR code for you to go ahead and sign up for that meeting. So my name is Neil Kane. I am a certified financial planner. I double up as a chartered federal employee benefits consultant. I've been in the industry for 18 years, working solely with federal employees for about 15 of those years. I'm local to the DC area, grew up in Rockville, attended Towson, finished up at Georgetown, live in Bethesda. So that's a little bit about me. About the presentation that you're going to be going through, RedFed is really about taking your federal knowledge and starting to become a little more strategic with it. So a lot of times you hear the information just given to you in a certain way, but it's not really given to you in a way of giving you a purpose or intention with that information. We're really going to try to get you a little more strategic and how that blends in with the outside world in terms of financial planning. So let's get started with the basic level items of being a federal employee. Now, we include all of the systems in here. We understand that most people do not fall in the old system category, which is CSRS, which is why I'm not going to spend a lot of time here in these first two. These are the original federal retirement systems. Few and far between really qualify for those. If you were accepted into the federal government in 1987, you qualify for FERS, right? So anyone that started working after that date will be FERS and one of those three systems under FERS. So I cover CSRS lightly these days simply because I want you first, folks, to just get an understanding of what the system used to be like. So before, the system essentially used to pay you about 2% of your high three average salary. CSRS would have an offset, which would basically be offset by your Social Security income. Additionally, the CSRS pension gave you up to 80% of your final paycheck as a pension. It kept up with the consumer price index, which essentially equals inflation, right? And it accrued immediately after retirement. There were some also additional difference with the ideal days to retire on that system. If we look at the FERS system, we'll notice some stark differences with this system. So when we look at the amount that you are compensated for each year of service, it's 1%, okay? However, the factor of 1% can increase to 1.1% if you attain the age of 62 or older with at least 20 years of service. We recommend that that is a goal for every federal employee. Now, it may not actually come to fruition for some. If you started very early in your career and you have the luxury of retiring sooner than that, you may consider that. But when it comes to the sweet spot of how much income you can earn from your federal package, retirement package, we recommend 62 with at least 20 years of service, simply because this is essentially a 10% bonus to all of your income coming from pension. Okay. And if you look at that, right, some federal employees think about retiring at 60. You only got to work 2 more years, and essentially you're getting a 10% bonus on your income. That's like working several more years more than what you would actually be working for. So those 2 extra years actually count as so like imagine if you were going to leave at 60 with 20 years of service, right? And imagine if you had that 60 with 20 years of service, right? Your pension factor would be 20%. Well, now, if you work until 62 and have the 22 years of service, you're essentially going to be getting a factor of 1.1% times the 22 years. So you're increasing your years of service and your pension to about, call it 24/25% of that factor. So I can actually do the real math for you guys and say, okay, so let's say 22 years times 1.1 is 24.2, right? So you are now getting a 24.2 factor instead of 20%. So what is that the equivalent of? We go from 20% in this situation. Sorry, my drawings are horrible. 60 and 20. So let me make that a 6. A 60 times 20 years is 20%. 62 and 22 years of service, 24%. So this was like you worked an additional 4.2 years, but you really only worked for 2 years, right? You worked from 60 to 2062, but it counts as a 4.2 year increase. So it's a kind of a warp mode to your service years in that last couple years. So to me, it's like, why not do that? You've already held on this long. You might as well be getting that additional compensation for those extra 2 years. That makes sense. Now, the FERS cost of living adjustment also comes with a increase to inflation, but it doesn't accrue immediately. So let's say you're fortunate enough to actually be in a place where you want to retire before 62. You're not going to get a cost of living adjustment until 62. Okay. And you additionally will not track the CPI index. So what does that mean? We expect inflation to be right around 3%. And if inflation is at 3%, you are going to be getting a -1 on your cost of living adjustment, which means your cost of living adjustment in that scenario will be 2%. If that happens for 20 years, you have 20% less purchasing power in the 20th year of your retirement. That is a considerable difference. So most people that are doing like a back of the envelope calculation and they're assuming, okay, maybe I'm going to need $25,000 out of my TSP, right? Each year, starting at, let's call it 62, right? By their 82nd birthday, they're going to need quite a bit more out of their TSP simply because their expenses are going to grow at a rate that is higher than the cost of living adjustment on their income. All right. You need to take that into consideration when you're doing your retirement planning, that it is not a stagnant number. It is a number that continues to increase. What you're taking out of your TSP is something that will be growing over the years. A lot of folks don't take that into consideration when they're doing that simple equation. So we alluded to the fact that, yes, you can retire before 62. By all means, I'm not telling you that that is like the only date you can retire, because really, as a first employee, again, you have the option to go at your minimum retirement age. And your minimum retirement age is based on when you were born. For most people, that's going to be probably in these days between 56, right, and 57, right? Could be a factor of months in there if you're in one of these kind of birthdays in between. But what that means is if you achieve 30 years of service by that minimum retirement age, that is the first mark at when you can leave federal service with all your benefits intact. Okay. Now, if you do not attain 30 years by your minimum retirement age, you still have the option to leave early. And by I call it early before 62 is early in my mind. You have the option to leave with 60 and 20 years of service. And that was the example I just gave. Now, if you don't have 20 years of service by 60, you then have the option to go at 62 with at least 5 years of service. You won't get the 1.1 factor here. This will only be 1%, right? Because in order for you to have 1.1%, you've got to have 20 years and 62. Okay. Horrible, horrible drawings. I'm off to a rough start on my drawings, guys, but hopefully you can understand them. First, special supplement. So I always get the folks that say, well, Neil, yeah, I get it. You're telling me that if I leave at 62, I get the higher factor. But keep in mind, right, that if I leave at 62, then I forego this special supplement. Tell me about the special supplement, because I hear about the special supplement a lot. Sure. So the special supplement is essentially something that was built to mirror Social Security for those that were retiring before 62, with their minimum retirement age and 30 years met, or with 60 and 20 years met. And essentially what happens there is you're able to get a a factor of right around 70 to 75% of what your Social Security would be at 62 from OPM early. So they're going to be covering that for you until you turn of age to draw social. And it's an extra bonus pension. But keep in mind, it's subject to an income limitation. That income limitation has gone up by a few $100. It was 18,240 bucks. It's around 19,000 now. We should update that. But if you earn any sort of earned income while you're on the supplement, you'll lose that, for every dollar you make over that 18,000 in this example, you'll lose, so every $2 you make, you'll lose a dollar. Okay. So right around 60K in earned income, you'll lose all your supplement. So what does that mean? Someone might say, well, I've got withdrawals from my retirement. I've got maybe some rental income. I've got my pension. So clearly that's going to be over 60K, or at least this 18,000 you're giving me. So am I going to lose my supplement? No. You've got to remember it's earned income. So earn, not passive income. Passive income is going to be all those other things we just talked about, dividends and the interest and all that. Not earned income is from wages or self-employment income. So unless you have that, right, you don't have to worry about losing that supplement. Now, how does the supplement work again? Just to be clear, you've got your minimum retirement age. Let's call that 57. If you've got 30 years of service, you're going to get that coverage until 62. All right. So let's say your Social Security at 62 is supposed to be 25 grand. Then you'll, like right here, then your supplement will probably be somewhere around 17.5 right here, right? In these years. Now, you'll also get the same option to do it with 60 and 20 years of service. So this gap. But again, if you don't hit that minimum retirement age with years of service met, you don't have the option for the supplement. So a question that usually arises is, well, okay, at 62, what happens? Well, the supplement stops. Does my Social Security automatically turn on then? No, that's your choice. Do you want to draw it early? Because remember, drawing Social Security early at 62, if let's say your full retirement age is at 67, is a 30% decrease from what it would have been over here at 67. So you have that decision to make if you want that income still coming to you. Now, the other question is, does taking a supplement affect my Social Security in any way? Is it like drawing early? No. The answer is no. It's coming from a different place. It's coming from OPM right here in this green, right? Not SS Social Security, right? So it's not Social Security. It's an equivalent-ish of social, but it's not. So you get 17.5 in this example. If you turn it on here at 62, it would be 25 there. If you waited until 67, it would be probably close to something around 40 in this example. Okay. So I hope that kind of gives you a different understanding of how that FERS supplement works. Now, let's talk a little bit about early out. A lot of questions about early out. Obviously, we have CSRS on the board. Most folks don't have to worry about that no more. So you're on FERS. So when you're a FERS employee, you get the option to leave early, but really your option to leave early has to do with minimum retirement age and 10 years of service. So let's say in that example, you've hit 57, you don't have your 30 years met, but you've hit 10 years of service. In that scenario, you can leave the federal government at 57 and receive your health insurance, receive your pension, but your pension is going to be reduced by 5% for every year you leave before 62. So if you leave at 57, it's going to be a 25% decrease. Okay. Now, someone might say, well, that's not fair. What happens if I've hit, um, let's say, what happens if I've hit 57 with 20 years of service? I've got my 20 years, so technically, wouldn't I qualify for retirement at 60? Yes, the answer is yes. So in that case, if you had 20 years of service, you would actually X out that 62 and it would be 60. So let me just get rid of that. So 60. So you would have a 5% penalty for every year you left before 60 if you had 20 years of service. So that's the way that early out goes. Now, the second option is saying, well, okay, what happens if I don't want the penalty? Well, then you can elect to postpone your annuity until age 62, and you will not have that 5% reduction. So the way that that goes is you postpone the receipt of your pension. And in this scenario, you don't have a penalty, but you don't have a pension until 62. You also don't have health benefits. If you postpone your pension, you do a postponed retirement, you wouldn't have health benefits during that period either. So let's say the example was 57, you left, you wouldn't have a pension, you wouldn't have health benefits, but you can restart those health benefits in that scenario at 62 when you get your pension back. Now, there's also what's called a deferred retirement. And a deferred retirement means that you were not age eligible or you were not years in service eligible when you left. Let's take an example of I had 54 years and 10 years of service, right? Sorry, I was 54 years old and 10 years of service. I've met the age requirement, but I have not met, sorry, I've met the years requirement, but I have not met the age requirement, right? So therefore, I'm not eligible for the postponed retirement. I can still defer my pension until 62, right? And I can avoid the penalty, but what I cannot do is get my health insurance back again. So a deferred retirement is very similar, but it does not allow that federal employee to get their insurance back again. So insurance is a very big deal. I'm going to be talking about that benefit coming up. It would be, in my opinion, that if you're very close to your minimum retirement age, you would not want to leave because you would at least want to make sure that you would be able to scoop that health insurance back again at 62. Now, obviously, if the decision is to leave a lot sooner for another career that you perceive is going to be way better, then sure, you can do the deferred retirement and you're not going to get your health insurance. But if you're close to your minimum retirement age, I would recommend to try to hold on because we value that health insurance. And I'll tell you the reasons why. Okay. Randomly switching to another benefit. So we just kind of got off of early out. We'll talk about annual leave here in a second. So all the annual leave that you have accrues, but only 240 hours can be carried over into the next year, which allows you in your final year of work, if you wanted to accrue 448 hours. That's accomplished by 240 going in from the previous year before retirement, all those hours going into your last year of retirement. You work that entire year without taking a day or an hour off, you would accrue 448 hours. That would be paid out to you as a lump sum times your hourly rate. Ideally, you try to retire at the end of a year. The reason for that is so your lump sum can be paid out in that year that you have just freshly retired, and maybe your income tax rate could be lower in that scenario. A lot of times we don't see federal employees dropping too far down in income taxes because they have all these they have income from social pension and they have their TSP withdrawals. And also tax rates could be higher in the future, but this is kind of the common recommendation is right there on that right side of this slide, which is retiring at the end, collecting that lump sum the year you start retirement in January. So what happens to your sick leave? So annual leave gets paid out to you as a check, which gets treated as wages, by the way. Um, Crediting unused sick leave is different. So it doesn't get paid out to you as a check, but it gets added to your service years. So imagine if you had 20 years of service and you had 2,087 hours of of sick leave, which equaled a year, you would then actually be credited with 21 years worked, and your pension, times 1.1, whatever it is, would be improved off of that number. Now, people ask, well, um, two questions that come up. Number one, if I don't get a full year worth of sick leave, does that mean I don't get the credit? No, it's by the hour. So again, it could be 5 months added to your service years or 5 months and 2 weeks added to your service years. So you get every single hour of that added to your service years. The other question I had, well, does that get me eligible to retire sooner? No, it doesn't. It's just kind of a bonus on top of that. So some other key benefits that you have is going to be disability. So your disability benefit is actually something that you aren't technically paying in for. It's running in the background of your benefits. As you can see here, there was two different types of systems. FERS is what the majority of folks are going to be on. And essentially what you have to understand when it comes for applying for disability in the federal government is that OPM is not going to classify you as disabled until Social Security does. Now that Social Security is a component of your income, whereas typically with CSRs it wasn't, Social Security's got to classify you as disabled first, which means you really can't be expected to work and earn over $1,000. There's also a delay before you're deemed eligible by Social Security as disabled. That is 6 months, I believe. I could double check that number. But bottom line is disability from the government is going to come once Social Security has you disabled first. From there, these are the payments, right? You're essentially going to have a 40% of your high three average salary coming from disability until the age of 62. And then you would move over to your pension in that scenario. But keep in mind, right, disability will be reduced by what you receive in Social Security income. Obviously, your pension wouldn't at 62, but it would prior to that in a disabled scenario. Okay, so we've covered some pretty key benefits so far. Hopefully, you've learned some new information on all of those. I'm going to give you hopefully some information you haven't heard on FEGLI because we do see some mistakes coming from federal employees in the use of FEGLI. So FEGLI is your federal health insurance. Sorry, federal life insurance. Um, Federal life insurance. Okay, so essentially you have different benefits, right? The basic benefit is by far the best. The basic benefit essentially insures you up to one multiple of your salary, plus $2,000 essentially, right? That's the fact. That's the way it's calculated. So if you have a $98,000 salary, your life insurance is going to be $100,000 on the basic benefit. Why do we like the basic over all the other options of A, B, or C? It's these 2 points right here. Government pays 1/3 of the premiums on basic only. And age is not a factor of cost on basic only. So the question is, for A, B, and C, you're telling me that the government doesn't pay anything there and that age is a factor of cost, meaning every year I age or as I age, I'm paying more for those benefits? Yes, it's only basic that actually is not a factor of cost. The only way you'll experience an extra cost by owning your basic life insurance policy, Begley, is your salary going up, which increases the coverage, right? That's it, not because you've aged. So that's a really important piece of basic. And for that reason, it's really only basic that makes sense to take into retirement because the other policies are going to increase as you age. So in order for you to take your basic into retirement, these eligibility requirements need to be met, right? You've got to have that policy for 5 years preceding retirement. You've got to be entitled to an immediate pension. The annuity is in here, but entitled to an immediate pension. So that means you've had to have your minimum retirement age met with at least 10 years of service. You have to then elect to continue your coverage. And obviously, if you cancel it, it's gone. So let's look at your options. So I said 98,000 turns to 100. It's actually 95, 97.5 because they round up to the nearest 100,000 and then give you 2,000 on top of that. But here's your three options for this basic benefit when you retire. You can choose to not reduce it, but typically y'all are paying about $50 to $60 a month right now for your FEGLI. And I can say that because I know it's not a factor of cost. So that's generally speaking what people are paying. But if you choose to not reduce it in retirement, you'll be looking at around a $300 a month policy. Why? Because there's no health examination. This insurance has no clue if you're in like literally the worst possible health shape possible, retiring at 65, taking a full unreduced benefit with you. So they're going to make it expensive. So what are your other options? It's to reduce it. So the most popular one is going to be the 75% reduction. And essentially what happens there is, let's say you retire at 62, right? You have $100,000 intact. You will pay this $50 to $60 a month. But at age 65, that's when it will begin its reduction by 2% a month. And at that age right here, that's when it will become free. So it will reduce to 25% of what you were covered. And essentially that will give you a free policy for your funeral and end of life type of expenses. That's what ends up happening to your basic if you reduce it. So let's talk about the additional options. So option A is the only place where I slightly misspoke in saying that none of these options really could be effectively taken into retirement. Option A can. The reason option A can, age is a factor of cost and it will go up every fifth birthday. It will increase, but because the amount of coverage is so negligible, it's like next to nothing of an increase. But what the option A insurance does is it allows you to do the same 75% reduction and have that as a free benefit at age 65, $2,500 of coverage. But other than that, nothing else you can do that with. So option B is the most widely used extra insurance in FEGLI. And let me tell you, we see a lot of issues with people doing extra coverage in their FEGLI. Why? Because you can insure yourself up to 5 times your salary, right? 1, 2, 3, 4, 5. But the issue is that it goes up every 5 years by 70%, the price, the premium. So it was once a fairly cheap policy at 50, 21 cents per $1,000 a month, cost you what? If you were insuring, um, 200,000 bucks, it'd be 21 cents per thousand. I don't have a calculator in front of me, but that's not horrible, right? But by age 70, it's $1.86 per thousand. So that is a what, 8 times increase? So you have to understand that it gets very expensive as you age. And so those folks that are on high levels of option B and plan to be into their 60s, not a good decision. If you believe you need extra coverage late into your career, it is much better for you to look at an outside policy, such as a term policy or some other life insurance policy that is going to fix that payment over that time frame, as opposed to an every 5-year jump. Okay. Now, those of you that are using option B that are, let's say, under the age of 50, you can continue using it. But at 50, if you want to continue still using this extra coverage, turn it into something that sets that policy premium in place for however long you're going to need it. Otherwise, you're going to be paying a lot more money from that point on. All right, option C, not going to spend a ton of time there because it's kind of negligible. It allows you to insure your spouse, your children for these, smaller amounts of money. No, it's not something you take into retirement. And it is, essentially just adding some extra life insurance on your family. All right. So one thing you got to take into account when you're taking out extra multiples of life insurance from option B is, did you know that you also have a death in service payout to your spouse that is essentially a free benefit? It is already there, it's automatic. And if something were to happen to you and you pass away while you're employed, your spouse, even if you worked under 10 years of service, is going to collect 32,000 plus 50% of your high three salary. So in the case of where you made 100 grand, that's going to be 82 and change, right? As a lump sum benefit. Now, the only difference is that this is going to be taxable and life insurance is tax free. That's why life insurance is so so widely used, right, in the industry, because it's tax free to beneficiaries. Pension survivor benefits, this lump sum benefit is not. But did you know this existed? And if you did know this existed, would that potentially reduce how much option B you've been using? A lot of people don't know about this one. Now, if you're in service for 10 or more years, you get the same lump sum paid out to your spouse, plus you get 50% of your accrued annuity. And when we use the word annuity, that's your pension. So essentially, the survivor pension would start there at a 50% level of your basic pension that you had accrued. So keep this in mind. Lots of folks don't know about this. It is something that you need to understand when you're taking out FEGLI option B. All right, so I know I've got questions. I don't want to open up the floodgate to the questions just yet, because there are close to 275 people on the line, and I'd want to make sure we get this done within an hour, and then I'm going to Q&A it at the end, if you guys don't mind. Let's talk a little bit about health insurance. So health insurance, right? You've got your different enrollment types. Great. You can do self and family, and then obviously your kids are covered if they're under the age of 26. You've got your premiums. Pay attention to this important part. The government pays 75% of your coverage. Okay. That is a huge benefit to you and your family, right? Huge. Not only to you, to your spouse. Now, coverage may be paid with pre-tax dollars for active employees. So what I'm going to say here is you're only paying 25% of your health insurance premiums. Government's paying the 75. You're using pre-tax dollars to pay your premiums. You're not using after-tax dollars. So that's another benefit. That makes the FEHB such a strong policy. And it's a policy that can also hang with you in retirement. Now, in order to take it into retirement, you've got to have these qualifications met. Specifically, keep in mind that enrollment for 5 years prior to retirement. If you do not have a 5-year enrollment prior to retirement, you aren't taking this policy with you. That's one of the big mistakes we've seen. We've seen people use their spouse's plan, at a private sector. All of a sudden they realize, oh gosh, I need to switch back over on my own to be able to take it in retirement, and they don't do it in time. So look at these differences in retirement. What do we see as a difference? The only difference is that you use after tax dollars in retirement because the government is going to continue to pay 75% of that premium throughout your lifetime. No difference to what they're subsidizing there. So when it comes to that benefit, boy, oh boy, this is one of the biggest benefits that you get. And what we also have to remember, right, is for those folks that don't have FEHB, their only choice is Medicare. Their only choice is Medicare. But for federal employees, you're always going to take your FEHB into retirement. You have the option to pick up Medicare. Now, Medicare Part A is going to be free, right? Because you're paying into it. And that's going to be hospital coverage, covers you for 60 days for an extended stay. And of course, you have deductibles. Part B is going to be health insurance. Now, it says that typically lower than FEHB premiums for retirees. Sure, but keep in mind, Medicare premiums are income based. And as you earn more money in retirement, you could end up paying way more in premiums. Look at a single filer here. Yeah, if you're under $91,000 of income, it's $165 a month. Great. But look how quickly you can jump up and double your premium. Someone may raise their hand and say, well, Neil, how on earth do you expect me to increase my income in retirement? I'm retired, right? Well, think about what's treated as income. Aren't withdrawals from your TSP treated as income unless they're Roth, of course? Do you in the age of your 70s begin what's called a required distribution, minimum distribution, that is essentially 5% of your TSP? Traditional is not applied to Roth, by the way. And isn't that treated as income, and isn't that mandatory? So you can find yourself very easily jumping into higher Medicare premiums. So what you believed was a low premium actually became a much higher premium. And that happens quite often to federal employees. So I always say FEHB is going to be by far your best insurance. You have the option to additionally pick up Medicare. You'll have Part A. You don't need Part D because it's prescription drug. You can pick up Part B, but really your FEHB is an adequate plan to be a standalone plan. It is now, and it is in retirement. You will be recommended that you should take Part B, of course, because it reduces the burden on the federal plan, the FEHB plan. And you will get a kickback from FEHB, a small one for choosing Medicare Part B, but it's not needed. For a personal reason, you can take and have both insurance plans if you believe your health is just not great and you want two insurances, sure. But it's not a slam dunk to take Medicare Part B. And that's why the FEHB, in our opinion, with the 75% subsidy, with the fact that it's not going to go up from an income scenario, is such an important policy. All right. And of course, if you don't have coverage, and you want it, there's limited opportunities to enroll unless it's open season, right? If you terminate your FEHB in retirement, you can't re-enroll. So I would never recommend to do that. You can suspend it for a Medicare sponsored plan, sure. And then obviously if you leave, you have temporary continuing coverage. All right, last couple slides coming up, and then we're going to do Q&A to finish this thing out. Here's some information on your flexible savings accounts as well as your health savings accounts. So flexible spending account is an account that is use or lose. There is an option to carry over $610 until March 15th, but other than that, it is a use or lose. Health savings accounts are not use or lose, but they can only be enrolled with a high deductible health plan, HDHP plan. So you don't have the ability to continue to carry over dollars unless it's a high deductible plan and you're using a health savings accounts with that. And the advantage to these plans are obviously you get to put pre-tax dollars in these plans and use that towards your health care. Okay. So those are some of the additional things that you can throw in your health insurance. All right. Rounding out some additional benefits. We could talk about the CSRS survivor benefit, but again, few and far between are on this system. It allowed people, once they retired, to essentially have the option to go from literally $1 a month to their survivor up to 55% to cover their surviving spouse in case they passed away in retirement. Why is $1 a interesting kind of play on CSRS? Because in order for you spouse to continue healthcare coverage, if you pass away, they have to be claimed as a survivor benefit for your pension. So for CSRS, it could be like, hey, I'm going to give $1 to my spouse a month, and that would have kept them covered. Now for FERS, you don't have the dollar option. You got to choose from either a 25% survivor, a 50% survivor, or zero. I would never recommend zero simply if you're married. And of course, you're not going to have a survivor benefit if you're not, because your spouse will be SOL if you essentially pass away in retirement. It's not a good scenario to lose your health insurance in retirement. So you want to make sure you've got one of those two coverages. Now, the special retirement supplement, if the spouse is under age 60 and not yet eligible for social, applies. So essentially there is a supplement if you passed away for your spouse, they would be eligible in that scenario. That's another survivor benefit. So taking a further look at this on a chart level, imagine if your pension was 50K. Imagine if you had a zero survivor benefit, then your pension would be 50K, right? Survivor benefit would be zero. But again, your spouse would lose eligibility of health benefits in that case if you passed. So your two options then in that case are going to be a 25% survivor, which is going to knock off 5% of your pension, which in that case would be that 47.5, would leave them with 12.5 in that scenario, or the 50% survivor. One thing to say though is if your spouse predeceases you in retirement, then your survivor, then your pension bounces back to the full amount. So let's say you took that 50% survivor benefit for them, right? Your pension got decreased from 50,000 to 45,000 because you elected for that 50% survivor, right? But then they passed away. You would go back to that 50,000 in that case if you were no longer covering them. So that's one of those attractive features that it's not like you're penalized if you're not covering someone. Okay. Changing benefits after retirement. So you get 30 days to basically say, hey, I made the wrong decision. I'd like to change. After then, it's an 18-month window that you can change. But in that scenario, you will have to pay back anything that you should have paid or anything that would have been reduced from your pension for carrying that survivor benefit. So imagine you retire, you have a $50,000 pension, um, you didn't you didn't check off a survivor benefit. 17 months later, you say, "Man, I should have taken the 50% survivor. That would have dropped you down $5,000 a year. You're going to end up owing somewhere around 8K in that scenario, plus interest. All right. And there are children's survivor benefits, by the way. So children's survivor benefits are also included here. So if your child, if you pass away and your child is under the age of 18, unmarried, like or under 22, full-time student, these would apply. This would give benefits, to your children. Okay. And that'd be reduced by Social Security. So one benefit I did include in here is your long-term care. It's not something that really is even ran by OPM. It's by the long-term care partners. I'll bring this up just simply because the insurances we talked about today do not cover extended stay at the end of your life in a long-term care facility. In fact, why don't I actually have a slide on that? Why don't I bring that up and just pull this right here and just bring this up. I sometimes do not mention this slide simply because, oh, looks like I need to go ahead and shift, looks like my slides. Okay, so you guys should be able to see that now. All right. Um, this is a policy in place that you can elect to use or buy into. Now, keep in mind, long-term care is for something that happens way late in life when you can no longer care for yourself. Your FEHB isn't going to cover you there. Your Medicare Part B, if you have that, isn't going to cover there. Your Medicare Part A is going to cover first 60 days. Okay. Sorry, first 120 days. I could double check that between those two. But after that, no policy is going to cover if you're going to a nursing home or you need nurses coming over to your house to help you. That's where long-term care insurance comes in. That's what this policy does. It is a for-profit policy, and it is not perfect. It has increased its premiums every single couple years by a lot. So even though you buy in early, you might still end up needing to pay way more for this policy than you thought you would have. But I like to recommend that this is an option because it simply gives you that insurance at the end of your life. Especially if you have history of dementia, those types of things in your family, this might be something to consider as it is a policy that can kind of come in and save the day. If you had to have a lot of expensive medical care in terms of custodial care at the end of your life. All right. Lastly, how does this all fit together? I mean, honestly, guys, you got to take a look at how all this fits in. All your benefits have to tie in. You can do an analysis. You can figure out, hey, if I start Social Security at 67, what does that look like? Hey, if I have a supplement right here and I'm retiring at 57, what does that look like? You need to look at this all in a very clear, concise way. You also need to look at, remember we discussed in your 70s, you have a required distribution. That's been pushed to age 73, by the way. But 72 was the factor before. What does that do to your income? When you have that distribution, that is required and it's 5% of your TSP traditional, what does it do to your income? If that's pushing you into a higher bracket, and let's say, prior to that, you didn't really need much withdrawals out of your TSP once Social Security began right there. And let's say orange was the withdrawals. And now all of a sudden in your 70s, right, that withdrawal starts taking off like a rocket. And now all of a sudden, right, let's say you were at 22% tax rate, maybe went into 24 for a second. Actually, that's 25 because tax rates are expected in 2026 to actually change over to the old rates. So that's why that's going to 25. And let's say in your first couple of years of retirement, you're dropping down in taxable income, but then in your 70s, right, your RMD kicks off from your TSP and now puts you in a higher bracket than you're currently at now. What does that actually do? Okay, in terms of a financial impact. Now all of a sudden you're in a higher tax rate than you even found yourself while you were working because tax rates have changed, because your income has increased out of your control. How does that impact your retirement projections? Those are all things that can be addressed with retirement software. So what we recommend, and then of course, what does it do to Medicare premiums if you decide to take Medicare Part B with your health insurance? So these are all things that can be addressed in a financial checkup. This is a complimentary checkup that we offer for 1 hour on Zoom. We address, should you be funding the TSP Roth instead of the traditional because you have too much over on that side and the distributions are going to create a problem, tax problem, a Medicare Part B problem if you use that. What are the ramifications of what you're doing? Is the allocation correct? When should you take social? When should you retire? What's your EGLI options? Are you using the right ones? Should you take Medicare or FHB? All of those things plus taxes can be addressed in one of these sessions. Now, I will tell you this, our general calendar is filled up for the next 3 months. However, we make a window of meeting times available for each presentation that we do for the next 3 weeks. If you are interested in getting a session and you want that done in a timely fashion, I would recommend signing up now, as that window will close and you will just fall in line with our general scheduling. That is up to you. It's a complimentary session. You can scan that with your QR code, or you can go to our website, retfed.com/register. Lastly, I will put that when it comes to looking for advisors, we recommend a broker check. Look at a broker check, see if this person is monitored by FINRA. Lastly, if they're giving you investment advice, check to see that this person is a registered investment advisor, because to be a fiduciary, right? To be a fiduciary, this person must be a registered investment advisor. Otherwise, they're doing it on a commissionable transactional level if they're giving you investment advice. You don't want someone recommending a commissionable product like an insurance product or an annuity product and making commissions based on their recommendations. A registered investment advisor does not operate in that capacity. Lastly, check for certifications. CFP is a great one. You got higher ethical standards, higher continuing education standards, 30 hours a year that has to be completed in estate planning, tax planning, and all those different areas. The other is background in federal employees. They don't need to be a chartered federal employee benefits consultant, but they do have to have an understanding of how all these things work out, what creates issues for you down the road, such as taxes or Medicare. That's all got to be part of a complete retirement analysis for you. So that's really it. We have a slide here that essentially gives you the ability to host a seminar for your own group if that's something that you're interested for, or there was certain folks in your department that weren't aware of this and you'd like to do something specifically for them. You can email us or scan the QR code. So that's all of the information for today. Again, you've got the QR code to register if you didn't on the last slide. And I want to thank you all for attending. Looks like almost all of you made it to the end. We've got questions that came in, and I'm going to go ahead and try to tackle those one by one. All right. So first question that comes up is, what does it mean to buy back time? So imagine if you went in the government, left the government, right? And were paid out the difference for the years of service that you had done on your first stint. Well, when you come back, you have the option to buy back that time and add those years to your total service years, which you will receive a bigger pension for. That is your option to buy back time. And in that scenario, it often is going to work out to your favor to buy back that time and increase your service years in the question that you're asking. Someone asked, what about 48 with 25 years of service? I don't have any context there. And I know that you asked that probably when I was talking about it and I did Q&A at the end. So I apologize about that. If you want to rephrase your question, I'd be happy to dive into it. And give me the full question because I'm already hiding just what you wrote here. So you got to retype it all out and just give me the full context. Tracy said, do you need spousal approval to discontinue FEGLI when you retire? No, you do not. That's your option to choose. You do need spousal approval, though, to go with a 0% survivor. And you need a spousal approval to make a withdrawal from a rollover from a TSP. Those are the only two things in my knowledge that you need spousal approval. Melissa asks, only a spouse, or do you mean your beneficiary? Again, context isn't there. So we lost the context because we're doing Q&A at the end. Anonymous, are disbursements taken from my TSP in retirement considered earned income and subject to the first supplement income? No. Earned income is only from wages and self-employment income. Passive and investment income is from TSP, rental income, dividends, distributions, Social Security income, etc. Pension, that's all passive. Kia asks, is this training going to be offered again? I have 20 plus new employees onboarding and most of them are from outside Fed. This info is so great. Pia, yes. Again, you have the option to email seminars at retfed.com, stands for Retirement Fed. It's a tongue twister. And ask, hey, when's this offered again? You can choose from some topics and offer that to your group through a QR code or through a link that we can send you all to register. Next question. Can you answer a CSRS offset question? I'm near full retirement age and wonder if I can draw my Social Security benefit while still federally employed. Will this affect the computation that will be done by OPM for my regular retirement? So it won't affect the computation, but if you draw your Social Security before you're retired and you are not 67 yet or your full retirement age, then you wouldn't receive it. So I'm assuming or hoping that with CSRS, you might be over the age of 66 or 67, whenever your full retirement age is. And in that scenario, you won't have a reduction, but I would double check with that benefit specialist in this case. It's been so long since I've covered CSRS offset. I used to do it almost implicitly 15 years ago. I had tons of that, but my thinking cap on CSRS is a little more foggy. I haven't used that information in a while. So double check with them, but from my knowledge, it wouldn't. Okay. Is it recommended for married couples, both federal employees, to keep FEHB individual benefits after retirement? Or is it beneficial to set up FEHB of family of spousal benefits? That's a great question. We get this a lot. It's something that I honestly need to do more research on in terms of pricing. The question is, should this person keep, they're both federal employees. Should this person keep a single benefit for employee one or retiree one and a single FEHB benefit for employee two, or combine them and do, a spouse plus one? The spouse plus one category was created maybe 5 years ago. I would really tell you to look at the pricing of spouse plus one versus individual and see what that comes up to. I don't know that answer off the top of head because I don't have the pricing of either of those options. Okay. I do intend to look at it. I'm copying your question and I'm going to actually look at if there is a pricing difference, but I don't know that off the top of my head. Question is, are the spouse and children survivor benefits do the spouse and children survivor benefits get paid even if the federal employee who has no FEGLI dies? Yes. Children's survivor benefits are independent of FEGLI. FEGLI is a different policy. Children's survivor benefits are from OPM. They come as a survivor pension, basically, to your children. They're taxable. FEGLI is a lump sum life insurance benefit, which is actually ran by MetLife, and it's not taxable. So they're just two completely different plans. Hope says, as someone who is new to all these benefits, can you briefly explain what high three salary means? Yes, Hope. High three salary means essentially that the government is going to look at the highest years you achieved in your salary and take those three, average them out, and then base your pension off of those three highest years achieved. So that means you could have, moved to a city like DC and had a really high salary, but then you retire somewhere else. Your high three salary does take into account that cost of living as well into it. Yep. Where can we look to see our TSP balance? On the TSP website. So go right to the TSP website. Now, Hope, you can't change your options for TSP Roth or TSP traditional. My recommendation as a new employee is for you to use the TSP Roth. And to make that election change, you have to go onto your benefits portal and go down on the left. There's going to be like a toggle bar. Go to TSP and change your contributions to go to TSP Roth. Okay. Sharon, can you share the QR code again before you end the call? Yep, right there. Joseph, what information should we have on hand to make the best use of the 1 hour consultation? Joseph, so that's a great question. We're going to be sending you an email as soon as you sign up with directions on what to do next. We're going to be sending you a link to fill out, which is a questionnaire of all the information that we'd like to know before your session begins. That's going to make the best use of your time and our time and giving you some recommendations. Donald, is the 1.1% annuity rate affected by having 30 years plus of service? No, it's not. The 1.1 begins at 20 years plus with 62 years of service. Anything beyond 20 years is 1.1 as well. Question. Your example of retiring at 54 demonstrated the reduction or deferral options. But do you begin to get a pension at 54, or do you have to wait until 57 or 60? No. In order for you to ever receive a pension early, the earliest that you could get that is typically at 57 in this case, right? Because the minimum retirement age for someone born 1970 or later is 57. Now, could you get it at 56? Yes. You have to look at that minimum retirement age chart. That's the earliest that you could ever receive a pension. And you would have to at least have 30 years of service without having a reduction. Or if you were okay with having a reduction, you would have to have 10 years of service, but then it would be a 5% reduction for every year before 62. 54 is not on that chart, so therefore you can never have a pension begin at 54. You could leave at 54, right? But you would not have your minimum retirement age met. You would have not 10 years of service yet, so you wouldn't get your health insurance back, but your pension would begin at 62. I know what I'm probably saying is confusing because there's just so many options and variations. I think the best way to go at some of these scenarios when people have questions about their own personal situation is like, tell me what you're thinking, and I'll tell you exactly what needs to happen. Otherwise, I just start throwing out a bunch of options and someone probably gets confused. But honestly, this Q&A is not probably the best suited for like very specific stuff. That would be your consultation. Next question. So FEGLI option B is not the best for over 60. What are my options? Outside life insurance. By 50, if you need extra coverage on top of your basic, start to look at term policies or WAPA. That would be my best recommendation there. Outside life insurance. Tracy, is the average high three salary gross or net? It's gross. Sarah, how can you use the sick leave for your advantage? You said it's a bonus, but don't you get, does it get you eligible to retire sooner? Can you give an example? Yeah, it just adds on to your service years. So again, if you were going to retire with 21 years of service, but you had 1 year of sick leave, you would get a pension based on having 22 years of service. It increases your pension. Okay, that's how it works. Julie, daughter turned 24, got married. Looks like I need to discontinue her FEGLI coverage, but does she still get my FHB? Julie, no. FEGLI has nothing to do with that. So unless you're talking about option C, okay, option C is for insuring children. I can go back to that. I honestly don't remember the age requirements for option C, but you would never turn off your own FEGLI. So yeah, okay, C. Okay, children must be unmarried of age 62, 22. There you go. So if that's what you're talking about, sure. But other than that, no, you would keep your own insurance. Okay. All right, we're gonna take a few more, but we also keep getting them, and like I can't go on forever, guys, because like my voice is also getting spent. So we're at almost 50 questions, just so everyone knows, and like I can only probably do about 30, and I've done 19. So what about 60? No, I can't do like add-on questions like that because I need the full picture. And I don't have the full picture because I've already deleted your old question once I went through it. The spouse question was regarding if I die while actively employed. True, Melissa, but again, I already deleted your old question, so I don't know what the old question was and what you're trying to add on to it. Sharon, how does military buyback affect retirement benefits for both military and federal retirement benefits? Sharon, so anytime you're in a buyback scenario, what you're doing is you're basically buying back time so that you increase your federal pension. So in that scenario, if you're going to lump those two kind of careers, military and federal together, which you can do, what you'll get is a larger civilian retirement pension by buying back that military time. So I would talk to that benefits counselor about, what it costs and all those things. But yes, recording, is it available? Yep, it's going to be sent to you. So will a copy of the presentation. All right. Question. What would rolling over my civilian 401k to a TSP do? I would highly pause you from doing that because once you do that, that money is trapped in the TSP until 59 and a half. It eliminates the option from doing things like strategic tax planning, conversions to Roth, things like that. The TSP does not have the option to convert to Roth, but your outside 401k would. So talk to a financial advisor before doing that is my recommendation. If you divorce after retirement, are you able to discontinue the survivor benefit? No. Okay. Generally speaking, you would have to have a court order to do that. What are your thoughts on the whole life insurance? Because your spouse has to sign off on that. So your divorced spouse would too, right? So in order for you to turn that off, you have to court order to do that because you're surviving your ex-spouse isn't going to sign off. What are your thoughts on whole life insurance as a long-term care savings vehicle? I haven't heard of that strategy yet. So I can't really talk about that. I mean, I know that people take out whole life insurance and are able to borrow on the policy. And there's a whole strategy around that. I'm not huge on life insurance because I'm an RIA. I don't use really many commissionable types of investments, and insurance is. I am insurance licensed, so I can use insurance when needed. I don't ever recommend, I don't solicit that to my clients, I guess you could say. So I don't have a lot of um use of using whole life in replacement of long-term care. I haven't had a lot of experience in, or haven't had any experience in doing that. But I can see where you're going with here in borrowing from it. That could be done. But when long-term care happens, guys, it's expensive. I just actually talked to a client at 9 o'clock, had a meeting with them. Their father-in-law is going through hospice, and the bills are astronomical. So a long-term care policy a whole life insurance policy at best is going to allow you to borrow from your cash balance there, which generally is not going to be like a huge balance. The death benefit could be. Now, I would be a fan of actually a life insurance policy with a long-term care rider instead. So the way that those policies work, to the person that just asked this question, is you get a life insurance policy that is a life insurance policy. It's got a death benefit. If you die, your spouse or your children get, let's call it 200,000 bucks in an example. But that policy has a long-term care rider so that if you ever need to access the death benefit, not the cash value, but the death benefit before you die because you needed long-term care, you can use that $200,000 death benefit for yourself for long-term care. So that I do have experience using, and I find that to be more addressing your scenario here better than a whole life policy. Question is, if both spouses work for the federal government, should both carry FHB into retirement? If only one carries FHB into retirement, pass away, is the other eligible for FHB? Yes. So, yes, if one passes, if both spouses are federal employees and they have their own policies, of course, they're going to be eligible. If one passes away and it was a +1, they're going to be eligible. So as long as you're insured under FHB plan, they're going to be eligible to continue it whether one spouse or the other spouse passes away. Does the high three include locality pay? To my knowledge, Tracy, it does. Hope you're welcome. All right. Yeah, so there's some questions that are still continuing, right? I'll take 5 more, but then I got to cut off just because I have a cutoff here at 1:15. I'll go a little longer. Let's go with minimum retirement age in 20 years versus minimum retirement age in 30. Both receive the 1.1% additional, correct? Yes. That no, no. Sorry. This person said minimum retirement age with 20 years of service versus minimum retirement age with 30 years of service. Both receive 1.1%. No. Per the slide, right? You have to have 62 with 20 years of service or more. Your minimum retirement age is typically 57. So that's 1%. Okay. 1%, not correct. Michelle, is overtime taken into your account for I3? I do not believe overtime is, but locality pay, yes. Is there a cap for the Roth TSP contribution? No. It's the maximum amount that you can fund your TSP with, which is about $23,000 or 30,500. So it's or 30,500 if you're 50 and over. You can put all of that to TSP Roth. If retiring at 62, does it make sense to delay Social Security to 67 and use TSP? Seen several articles that say if you withdraw at 62, that it's not until you're 85 that there is an even out of when there is a catch up or if you would have waited until 70. All right. So the person asking, like, does it pay to wait to draw Social Security? So the break even age between 62 and 67 is 78 years old. As long as you live to 78 or longer, you would have actually been better off waiting. Another reason to wait is if you find yourself in a low tax bracket during that window from 62 to 67, you could actually convert some of your thrift savings plan to Roth while you're in that low income tax bracket. So that's a strategy we utilize a lot for clients. So there's some additional pieces around that that you want to think about. But yes, we normally recommend trying to hold off to take social and not taking it at 62. All right. So someone asked, I worked for USDA for a few years in the middle of the 60s. Would there likely be any benefits hanging on from those early years? Now 74 years old, still working. I'm in my 15th year of this iteration. Yes, absolutely. Buy back that time because that time is going to be very cheap because you didn't earn a lot, but it's still going to count as 1% or 1.1 if you get 20 years of service, and it's going to work out to your favor. So 100% get that back as soon as possible so that it's not more expensive because you'll have to pay some interest on that, but it will be worth it for you for sure. Buying it, I'm single first. Can I forgo Fegley when I retire? Sure, but if you paid into Fegley all this time, why would you forgo it? Just turn it into a 75% reduction and get it for free. Who can help us change our TSP as we get closer to retirement? We can help you with those decisions, Karen. Sure. That's one of the things we do on our on our consultation. We can give you some pointers around TSP allocations. All right. I currently have a medical plan, family medical plan. How do I sign up my spouse to make sure once I retire and pass away, he'll continue to have medical coverage? Well, you keep that plan or you drop it to spouse plus one and you make sure you give him a survivor benefit when you retire. Either that 25% survivor or the 50. That's how you do it. Nathan, if you're retiring less than minimum retirement age, do you still get credit for your sick leave time as a calculation? Yes, you do. Yeah, you still get credit. That sick leave time would be accrued. As long as you got 5 years plus, it would be added to your pension. If you don't have 5 years plus, it would just uh you can elect to have, if you don't have 5 years, you can elect to have your service years paid out on your FERS, but it wouldn't be much in that scenario. Does Fegley option A and B make sense for someone in their mid 50s? It's a toss up. A is fine, it's negligible, 10 grand, but B, I really would try to look at an outside term over hopping in the option B in your mid 50s. Because at 60 years old, you're just going to have another big increase. Right. When is open season for life insurance? Ah, great question. Life insurance is hardly ever an open season. So your health insurance has it every year, but your life insurance is, there's been like 10 years that have sometimes gone past. So in order to get life insurance, typically you need a qualifying life event if you didn't sign up for it at the beginning of your career. Or just look out for open seasons, but like they come few and far between. Would you recommend switching contributions to Roth TSP rather than traditional for someone with 26 years of service and no plans of retiring soon? So that's a hard one to just address just like this. I think that it depends on your tax bracket now and what your tax bracket's projected to be in retirement. It's also predicated on how much you have saved in your traditional and what the expected required distribution is going to be. It also is expected on how much you're going to need from your TSP. And if your required distribution is going to be way in excess of what you need, and it's going to be forced out and put you in a higher tax bracket, then yeah, you might want to switch to TSP Roth. But I would project that um, and give you the final kind of decision on that by looking at your own figures. So instead, I just turned 31, started in November. I'm buying back my 5 years for my military service now. Is there anything suggest to maximize my retirement, set myself up for success? Well, you're doing the first thing right, buying back your time. Perfect. Next is fund your TSP. Make sure you're funding that as much as you can. Make sure you're using Roth at 31 years old. Make sure you're also investing that aggressively. Make sure you're using the C fund, probably the S fund, and a little bit of I. But that's the three I would use. I wouldn't even use any of the F or G. And I would just go almost all C and S, a little bit of I on that TSP, and that should set you up for success. And don't look back. Don't even look at it again. Just pump out Roth to those mainly two funds, and I think you'll be good. Um, all right. Couple more. Are you able to roll a 57 from a previous poor employer into TSP? Yes, but I'd highly recommend against it because the TSP locks that in. So I'd speak to an advisor, financial advisor, before you roll into the TSP just to see what your other options are. All right. Cool. So these are really it. Looks like we finished most of these questions. What is a Roth TSP and what is the differences? Are there income restrictions for starting a Roth TSP like an RIA? No. So there are no income limitations for putting money in your Roth TSP. And the dollar limits do not apply to the Roth TSP like they do to the Roth IRA. And the difference with the Roth TSP is your money grows tax-free and it does not get subject to an RMD at 73 years old. Huge difference and really key plan. Does FEGLI option A and B make sense for someone in their mid-50s? I think I already answered that. Yeah. Can you change FEGLI at any time once you have it? You can reduce your FEGLI at any time, but you can't increase it at any time unless you have a qualifying life event. Melissa said, is there any minimum investment amount needed to hire a financial advisor from your company? What we do is we start off with an analysis. The complementary one. Then from there, if you want something that is really focused on your scenarios like taxes or future projections, then there's a plan that is a cost between 750 to 900 bucks. That gives you a lot of information. And then from there, if you want your assets to be managed, then there are minimums, but that all depends on the advisor you work with. So I would just, from there, Melissa, if you're interested after that, then I would talk with the advisor and just see what the minimum is, depending on who you work with. But you know, your first part is just making sure you got the numbers right. Don't worry so much about investment. Worry about making sure you're doing the right thing, and that can be done without any investment. Now, that's why our company is a little different. There are other advisors that you have to invest with them first. We don't operate that way. All right. Cool. Well, sorry for losing energy at the end. I hate doing that because I know my voice started to, but I am tired. So that was all the questions. I got them all done for you. I felt bad of leaving those last people high and dry, but I definitely will say that's it for today. So until next time, guys, if you guys didn't get a chance to sign up and you want to sign up, there's your QR code one last time. But you all take care, enjoy the rest of your days, and thank you so much for everything, for your positive feedback. And there is a questionnaire at the end if you'd like to give us some pointers or some feedback. It's all good. Thank you. You guys enjoy. See y'all next time.